We're all talking in accents.
We start every session off laughing.
Well, I mean, what are you going to do? Hey, it's
We're talking about plants today, right?
No.
That was
that was the last one.
Oh,
You just missed that segment.
That was fun to watch, though. I liked it.
It was cool. It was cool. It was very fun. But no, we're going to talk about Wall Street. Oof. We decided we wanted to push Shauna's buttons today.
Yeah.
She got tired of just us talking to each other last time.
We were talking to each
Yeah,
other
I sat back and they just...
We were just kind of like this.
Hey,
it's like, yeah, dude, yeah, isn't that crazy?
Right. The feedback we got was we needed the attractive
Shauna,
one.
yeah,
to have
we
more
want to hear. We want the
stage
close-up
presence.
of the girl, not you guys. So, so then the question here is, do you really think Wall Street has your back? And I think most people believe that Wall Street is sort of this greedy, ugly place.
Mm-hmm.
But they think it only exists in Manhattan.
That is also true.
Right?
Yep.
So like...
Well, isn't that the case?
They have your back in the sense that they're putting the knife in it.
Exactly.
They definitely have you turned around.
Right.
That's for
Right.
sure.
And they're twisting. You just don't feel it as much.
So, but where does Wall Street extend to? And, you know, what happens there? I mean, like, so there was an article, actually I'll pull it up here. So this, I actually posted this on my personal Facebook. And, you know, we see stuff like this, you know, the market, we see like new all-time highs, right? Anytime you see like new all-time highs, things start to get a little wonky, gets a little crazy, what's going on. But then I looked over here and I saw this article, which is talking about Fidelity, and Fidelity has a lot of these funds with target dates and things like that. Like this is our 2030 fund. If you're going to retire in 2030, this is the fund you should invest in. And I'm like, wow, that's so amazing that you guys know exactly.
Well, they don't just have one fund. They have over 1,000 funds.
Right.
Right.
But no, the 2030 fund, Shauna, let me explain this to you. I don't think
This
you
one's
understand
going to do the best.
how this one works.
Tell me about the algorithm.
The 2030 fund, if you're going to retire around the year 2030, then you invest in that fund and it knows exactly when to peak so that when you start retiring, you can pull the money out.
Wow. Sounds like something you can sell.
That's why it's called the 2030 fund. It sounds very sellable, doesn't it?
Oh, yeah.
Like, I'm going to retire around 2030, so that's where all my money is.
Oh, yeah. Makes total sense.
Right?
What could go wrong?
This is working out perfectly, but but people buy it though, and see, and that's the thing, and I'm sensitive to it because I do understand that people want this to be easy. People want it to be this easy, and I also understand that's not. What's really interesting on here is Fidelity has seen a nearly $16 billion net withdrawals over the last 4 years, according to Morningstar. Wow.
Yeah.
So what happened? Did people stop believing in it, in the 2030 funds or whatever? But the point of this article, and you can find it on CNBC, and I'll actually I'll post it below in this if you want to check it out. Well, what it was saying is that, well, you've committed now to having these funds that have these target dates, and so in order to meet your projected goals, you have to now take on additional risk. There's really no other way to do it. So this idea of having a certain type of balanced portfolio that's going to get you to a certain year, if that isn't working out for some reason, or you don't have the funds or whatever it is, now you have to take more risks. And so I think the thing that is probably outside of most people's comprehension is that you have just as good a chance at beating the market as anybody else, right? Like, it's a pretty level playing field. That's the cool part about it.
It is the cool part about it.
Well, everybody has a chance. I mean, who knows why the $16 billion went out of Fidelity?
I don't know.
Exactly. We could come up with plenty of theories about why that happened.
And I'm not saying it's like this huge red flag or anything.
Yeah.
I'm just saying that when you look at these things and you go, well, these guys are even struggling to hit what their very high hopes were.
Right.
But it reminds me of the reality that we all have an equal chance. And this is what you guys talk about all the time. This is why we're such good friends, because you guys give me such great money advice. And I'm like, wow, I have to keep talking to them because I feel like the well isn't dry.
It's not. There's a lot to it. There's a lot to it.
Well, Fidelity's might be soon. I don't know. We'll wait and see what happens.
So you have to think about the fact, right? So like a 16 billion withdrawals in the last 4 years, right?
Yeah.
In that time, we've had some pretty significant market growth, right? And actually in the last 8 to 10 years, we've had some pretty significant market growth. So when you start to follow the math and follow the numbers and follow the money, it's like, this would be my hypothesis. I don't know. My hypothesis is that when the market's up is when people become very sensitive to returns. And it's when advisors start to sell returns. Oh, well, look, your Fidelity 2030 portfolio only did 19%. Our portfolio did 25%. Don't you want that? And without any other level of understanding, we're like, well, yeah, of course I want that. That makes more sense. And that's the biggest damage that Wall Street does, is it sells returns without any discipline of behavior. And so, like Fidelity in this case, they're just not selling it good enough, which is why if you read in the article that you posted, it says that they've switched to a more market timing active management model because they're trying to seduce people into working with them. Mm-hmm. So, oh, well, this isn't working, we're losing all this money, so let's try to time the market so that we can be better than other people and then get more money. Mm-hmm. And it's just a crazy concept that keeps getting pushed out, despite all the research, mm-hmm. all the proof that active management doesn't work. By and large, it doesn't work. And you can see that to a certain degree. You've got like Betterment and all of those larger, all the kind of like do-it-yourselves.
Yeah.
And what you're saying is active management. Let's define that real quick for people who don't know what that means. So, like, active management doesn't work. That's a big statement. Active management doesn't work, meaning like if I take, let's say I have $50,000 in the market, I buy the S&P today mm-hmm. because I think it's going to go higher, and then at the end of the day, after it's gone higher, my plan is to sell it all and then see how I feel tomorrow. That's active management, right? You're trying to buy and sell constantly as the market moves.
You're essentially trying to time the market.
Yeah.
Right.
Well, there's 3 ways of active management that we've seen. Mm-hmm. You've got stock picking, which is there's 20,000 stocks that exist in just the U.S. market space. I'm going to pick 1 or 2 or 5 or 10 that I think are going to be best, as if I can somehow guess out of 20,000 possible what's going to be the right one. And then you have market timing, which is, oh, I think that the U.S. market's going to be down, so I'm going to get into international market. And you're timing what area is going to do what. And then you've got track record investing, which is what most people get sucked into, which is, oh, well, these guys did really good for the last 10 years. They did way better than those guys. So I'm going to invest with them. And how it almost always happens is, coincidentally, either they get busted for a Ponzi scheme and everybody loses their money, or after you invest with them, weirdly, they do worse in the market.
It's just a strange thing that happens.
Yeah. My dad would tell you all about it. He goes, I don't know why I bought this stock, and right after I bought it, it went down. I'm like, because you bought it. Like, just do the opposite of what you think you should do, and it'll work.
Can you fade yourself? Does that work as a strategy?
Oh my gosh.
People would be great traders if they could do that. Just whatever you think, do the exact opposite of that, and you will make so much money.
There's a Seinfeld clip about that with George.
Is there?
He's like, you know, everything I've ever done has been wrong, so it stands to reason if I do the opposite, it'll be right.
Oh, I remember that.
Yeah.
And he starts doing everything opposite, and it's working.
Yep.
And it starts working, and he's like, feels like this genius moment.
But everything you see online, even this title here, it talks about fear. So it's not only, they're not only selling the return, they're selling the fear.
Why is fear good for them? I mean, wouldn't that cause
Fear is
people...
good because if you sell at the bottom, they can capitalize on that. They're buying it at a discount. You know what's funny? Remember that commercial I sent you the other day? So it even happens in our industry. Our industry plays off of people's bad behavior. There was this commercial I saw that literally the tagline was something to the effect of, no emotions, only results.
Oh, that's right.
And I was like, hold on a second here. Number one, there's going to be results. They may be bad, they may be good, but there will be some form of results if you invest with these people. And number two, no emotions. Are you kidding me right now? I couldn't believe it. You are actually putting this stuff on TV, trying to get people to invest with you.
I'm sorry I just whispered because you can't curse on Facebook Live, and everyone knows pissed. Oops. Is a really bad word.
Is it? Oh, crap. Is
crap Are you kidding? Because I hope so.
Right.
So anyways,
we don't want to go to Facebook jail.
If there was a Facebook jail, I'd be there right now with a life sentence.
We're going to get cut off right in the middle of this segment, probably.
You guys are done.
So how could you possibly not have emotion in investing? Like, these are people's life savings. Like, it is not easy to actually save your money. Like, that is actually a very hard challenge for people to save.
So tell us, where do you begin then? Because, okay, it's a challenge. We've leveled the playing field. The pros have a hard time. You know, how does it begin for the average person to be able to say, all right, well, I want to get a leg up? Like, what's the first thing?
Well, it's definitely not to turn on the TV and do whatever the talking heads are telling you.
No?
No.
Aren't those guys smart?
We told you we're going to buy an 8-ball and name it Jim Cramer, right?
Just shake it.
Yeah.
Yes.
Have people call in.
What's the market going to do today? Try again later.
So here's your one
tomorrow.
option.
Going to try tomorrow.
Should I buy GM?
Let's ask.
No.
So I think the starting place is to actually educate people on the academics around investing.
And what are those
Nobody
academics?
is talking about the academics.
What are the academics? Let's talk about the academics.
So one of the academics is the efficient market hypothesis, which basically says that all knowable information is already reflected in the price, and any unknowable random events are the only things that can affect the price.
So meaning that today, if you think, oh, well, I know this thing that I read in an article from a week ago,
So I
is
should
going
try
to
and
have an
capitalize
effect.
on that and make a market movement based on that.
It's already in there. There's something that you know, you hear traders say sometimes, buy the rumor, sell the news, and you know, I don't know if that means anything or doesn't. But I
It
think
might. I mean, it means something.
the idea is, I think that
Something to someone.
yeah, the idea is, hey, remember, do the opposite of what you think you should do.
Right.
It's kind of what that is, because everyone else is going to be doing the same thing. Right?
Right.
And if you have a whole bunch, if everyone thinks that we should sell because the prices are too high, then that's kind of what actually makes prices go higher, right? So it's a weird thing, the market. It's very counterintuitive.
I saw I think it was an E-Trade commercial, but after they got rid of the baby. I think it was an E-Trade commercial where this guy's sitting in an airport, and he pulls out his laptop, and he looks at like a coffee shop name, right? And he like looks it up, and he finds a stock symbol for it, and he buys it. And it was like, you know, follow your hunch, or something that, you know, something that like your hunch is your best friend or whatever it was.
Really?
Yeah.
Your gut.
And you sit back, and it's like, it's not something that I think it only occurs to us after being in the business for 8 years and watching it be done. But you sit back and you're like, so wait a minute. This guy just bought this stock without understanding what that company's internal workings are. He doesn't understand what their profit or revenue or their generation is. He doesn't understand what their expenses are. He doesn't understand what legislation's impacting them. He doesn't understand what the airport's going to be doing that might be affecting their ability to stay in business. He doesn't understand what international travel is going to be doing that might be affecting the travel to the international airport. What about international taxes, international government impacts? Like, everything is impacted, and there's no way to know it all. And that's the idea of the efficient market hypothesis, is that the price is what the price is, and the only things that are going to change it are things that we can't know in advance.
Are you sure? Because I'm pretty sure Bitcoin is going to $1 million. Oh, wait. Actually, there's an article here.
It is going to $1 million.
We're just making a quick pit stop at $8,000, I think.
Hey,
Great buying opportunity for the coin of bits.
It's gone down by low.
you know, 2 steps forwards, 30 steps back. You know, you do the math on that, it'll be to $1 million in, I think, 3 hours. I think that's how that works.
3 hours from now.
Right. Yeah. I was telling her
Bitcoin.
how amazing it would be if we used Bitcoin as a currency with its current like fluctuations. Be like, how much is that piece of bread? Well, it's 0.003 Bitcoin. Okay, it's 0.007 Bitcoin. Okay, it's
Hold on.
1 Bitcoin now. All right, hold on. It's just buy it. Just buy it already. I don't know how much it's going to cost.
1 millionth of a Bitcoin now.
Yeah.
It's true. That is the thing that's really interesting to me about it. The whole thing is fascinating, but this is something that a lot of people are talking about. A lot of people are talking about this, and there's actually been a guy who I'm having a conversation with today. I would like to bring on the show with you guys or one of you, and have a discussion about it, because
Shauna
there is a
What is the baseball bat used
he
for?
wants. It's sort of like it's a few good men, thing. You know,
okay.
I think better with the bat. But
He can't handle the truth. I'm sorry. I'm sure there's something we're supposed to be getting to.
No, I mean, there's this guy who just like, he's reached out to me a few times. He's like, I know inside and out of cryptocurrencies and how they work and where it's headed and the technology and the applications and stuff like that. I want to come talk about it on your show. I have a conversation with him later today. So I may want to try to set that up with you guys. We could obviously be having this conversation another time, but
all right.
But
I think it sounds fun.
yeah. So, but we see things like, you know, in the world of, you know, of stocks or whatnot, and I noticed this with Amazon, right? Like you see, oh, here's the big news, Amazon, you know, whatever it was, and then you look, well, it's already there. Like it already went up $200 a share today.
Right.
So does that mean I should buy it now? Because the news just came out, but the price is already up $200 a share. It's very tough to know.
Well, you'd be missing out if you didn't buy it now.
Right? So
Shauna, don't say those things.
That's what the media is telling you.
I could buy it from you,
Yeah.
right? Well,
no, I wouldn't sell it to you, but you know.
Oh, you wouldn't? Thanks.
Wow. It's aggressive.
It's cold.
That's
Just
stock
ice cold.
picking. That's not in our.
Not in your thing.
That's not in our philosophy. So.
Oh, yeah, that's right.
Let's talk about some more of those things. The academics is where we were headed.
Yeah.
That everything is already priced in. So whatever inside knowledge you think you have, you don't. Plain and simple.
Yeah, basically.
Okay.
I mean, there
if
are moments in which someone through insider information or through additional like resources might be able to get something that then goes up. But it doesn't mean that it's something that's knowable, like that the whole populace would know it, or that it's something that will continue to be what's called a risk premium. Risk premium is something that you take risk and you're going to be compensated for it. Generally what happens is when we think something's a risk premium and then everybody finds out about it, it disappears. There's only 3 risk premiums that have actually been proven to exist for the last 100 years. And that is investing in stocks and equities versus investing, or like bonds, it's just something that's fixed income. Investing in smaller companies versus larger companies. And then investing in companies that have higher book-to-market values, meaning they're a little bit more distressed. Those 3 areas over the last 100 years of research and data have shown to consistently produce higher returns for the risk that you're taking.
Which is more academics. It's called the 3-factor model.
Yep.
Interesting.
But people don't talk about it.
Why not?
Doesn't sell.
Because it doesn't sell anything in Wall
sexy
Street
enough?
and
So
nobody's making money.
what date is it going to be good for me to retire? No, what year? I don't want to hold you to a day.
You want to have a fun one for a second. Here's what's crazy. We can get into this like really deeply on another show.
Okay.
But what's really crazy is when you start to do the analysis. So you've heard, and Wall Street talks about it all the time, and financial advisors talk about it all the time, that you're supposed to become more conservative as you get older, right? Like that's what that 2030 is designed to do. Is as it gets closer to 2030, it becomes more and more conservative. Did you know that factoring it out and modeling it out, conservative portfolios, by and large, will run out of money faster than portfolios that are still invested in the market?
So you meaning when you retire, stay invested?
Yeah. So why is it that the advice that everybody gives is counterintuitive to what would actually keep money in your pocket in the space of retirement? Well, actually in the space of everything, but in this particular instance, why would we give advice to go more conservative when you get older when it's actually demonstrated, we can demonstrate for the last 100 years of data, that you would end up, and running Monte Carlo simulations, which, you know, give us a whole bunch of graphs and whatnot, that being more conservative would have a portfolio fail more often. Why do we do it?
Meaning run out of money in retirement.
Yeah.
Well, that's what we call failure.
Okay. In your world,
if you're still alive and you run out of money, that's like losing the 3 lives in the game. Game over.
Game over. Yeah, that's not a fun thing to go through, I imagine, and it's something that's happening more and more often, unfortunately. And there's one thing that you can't get back is time, right? So there's no reason to, you know, dread, oh, I should have done this, you know, I should have done that. The only thing you can do is right now, make it, you know, do something different now, right now. That's actually a really interesting concept, though. I think we should model that out. I think we should demonstrate that.
That'd be fun.
I'd be fine with
you
that.
know, with numbers and the Monte Carlos and whatever other vehicles you want to bring on the set. But
I'll bring my toolbox.
Because you're right. And you know what? That advice makes sense. No, it does. The advice that the common advice. No, you want to take less risks now. You have enough money. You know, you hit the number you were looking to hit.
You don't want to lose any of it.
Yeah, you want to reduce the opportunity for you to lose money. The market crashes happen. right? People, we've experienced a couple of them in our lifetimes.
And it will happen again.
Yeah, absolutely. There's
And
no way around that.
you cannot panic. Like, you don't panic at the bottom.
It's one of the saddest things. Fortunately, my grandpa was a great little saver. He was a great little saver. I mean, he's just a great little saver. He he was. I mean, the guy, he never made a lot of money, you know, but he saved so much. And even when, you know, he did pass, he still had hundreds and hundreds of thousands of dollars. It's crazy. But, you know, he'd also lived through a period of time where CDs paid 15%. Right. So, you know, a little bit easier.
Right.
But one of the things that really saddened me was in the stock market crash of 2001, he sold at the bottom because he couldn't take the pain. He was down 40% and couldn't take the pain.
Ouch.
He worked so hard for that money for so many years, and he handed it over. It broke my heart when he told me that. He didn't call me, didn't ask anyone. He just couldn't take the pain anymore.
Yep.
It hurt so much that he sold.
Yep.
And everyone was probably telling him to. Yeah.
Hard to say.
I
I don't know who told him.
I'll tell you what, that's the biggest, not discrepancy, that's the biggest problem I have with the industry is, outside of Wall Street, just the actual financial advisor. The actual financial advisor in most instances is just an enabler. That's all they are. They exist. That's why that advice of becoming more conservative as you get older is the prevailing advice, is because we're just enabling people. Oh, you're concerned about the risk? Like you feel like concerned? Well, instead of me teaching you that you'll actually have more money if you can manage your behavior and your emotions and stay invested, I'll just cater to what you want because I want to get paid on your money.
Because it's easier.
Well, and because I get paid. Like,
Yeah,
if I do what
when
you want to
sell,
do,
somebody gets paid.
well, no. I mean, like, if I do what I want, if I do, you call me and you say, well, Thomas, I want to get more conservative. I have two options, right? I can either do what you're asking, or I can provide you with education and teach you what the alternatives might be. And one of the two of those would mean that I'd be paid much easier, right? If I just do what you want, you're happy because your guy does what you want him to do.
You get to keep the assets.
And then I would still get to get paid on the assets. Whereas if I challenged you, you might take your money to somebody who would enable you instead of actually teaching you. And so financial advisors, by and large, are just enablers. Oh, you want to move to cash in the bottom of the market? Well, okay, I'll still manage it for you. I know it's bad for you, but like I like getting paid.
But I'll charge you 1% on the cash.
Right. That actually
It's
happened.
criminal.
We had a client who was had almost she had $500,000, almost 200,000 of it in cash, paying 1% on it.
She was paying 1%.
On the whole portfolio. So the cash was paying 1% as well.
Wow.
Yeah, great deal. Great deal.
For the advisor.
So if that's going to be the case, right? If you're going to charge 1% and
That's
then get it on the cash, of course. Oh, you want to move to cash? Cool. I still get paid, and that is the majority of the industry. It's a travesty, to be honest. Like, we have such a responsibility to people. If we do what we do right, people's lives work out. They have money, they can give to charity, they can give to their families, they can take care of others. If we don't do it right, we don't help people, they might be working the rest of their lives, giving nothing to anybody. Like, that's the difference. And to just enable behavior because you want to get paid instead of doing what's right and risking the fact that the client might just disregard it and go elsewhere, that's a serious breach of responsibility. Serious breach of responsibility.
Is that why you guys named your firm Paradigm Shift?
Yeah.
Was that the paradigm shift you're talking about?
That's one of the many. Yeah.
Well, that sounds like a pretty big one.
It's a huge one.
Because most people their behavior will be driven by compensation.
Yep.
And what you're saying is, we're not going to do that. We're going to do something different. It may cost us, but we're going to sleep well because we're going to tell people the right thing that they should do.
Bingo.
Yeah. We set up rules for them, parameters that they can follow within their portfolios, and if they step outside of them, if they want to do something that isn't in the parameters, we kindly ask them to take their assets somewhere else.
Well, actually, in some instances where people have, like, we've had people that have said, I want to go to only U.S., or I want to go only international, or I want to, buy gold or whatnot. And we walk them through how that's not going to be most powerful. And there's some people that just aren't done gambling. There's some people that want to have such control that they're willing to risk that level of essentially willing to risk their money to that level. Mm-hmm. And we'll just say, look, we're not going to do it. We'll sign off on your account. You can take it elsewhere. Like, we'll just absolve ourselves. You can go take it elsewhere.
So you said something really powerful there. Some people aren't done gambling. You think that's how most people look at this?
Mm-hmm.
No. I don't think most people, we look at most people gambling, but I don't think that they
probably don't think that it's that, but their emotions are exactly in line with gambling.
Yeah. They're making it a gamble. Mm-hmm. Because it doesn't have to be. I mean, it's essentially an investment. You either have a win or a loss, right, in any investment that you make. And so it's easy to associate the two. Like, hey, I didn't do anything. It's like, spin the wheel, hits my number. All right, I made money. I didn't do anything. Mm-hmm. Put this money in here on the computer screen into this little four-letter thing. It went up. Oh, I made money. Right. It is kind of similar. It's hands off, right? So it kind of feels the same. So I could see where that association might be tough to break.
Excuse me. Yeah.
And that's a big challenge you guys have given yourselves, to try to really teach people not to look at this like gambling.
Thank you. Should we explore something else now that sets it up that bar really high?
Yes.
Maybe we should just start enabling again.
Just start enabling again.
Yeah, we also in that space we also won't take clients who just say, what do I do with my money? Here's the money, just take it. And there's two reasons we won't do that. Is number one, it's because that level, it's their money. We shouldn't care more about their money than they do. So for them to just hand it over without ever wanting to learn about it or know what's going on, red flags kind of go up for us. On that. And the second is that only works. It only works when it's working. So it's like, oh, I trust you. Here's the money. And I know you've got my back. Here you go. And then the market does what the market does. Let's say it takes 1,000-point dip, right? All of a sudden, I guarantee those people were the ones calling their advisors going, what happened? Why'd you lose me money? Oh, what happened to that trust? Where did that trust go that you didn't want to learn about the account? All of a sudden, now you care? Weird.
Which that happened.
Absolutely.
We had a 1,500-point drop, I think, in a week or something in the Dow.
In a week, absolutely.
And turned out maybe it was a decent buying opportunity. I don't know where it is now with respect to that, but I know it came back pretty quickly.
Mm-hmm. But during that time, those websites that don't do any teaching, the ones where you just invest and you're supposed to manage your own behavior, Betterment and
crashed.
Just imploded. People
literally
droves took
crashed.
their money out.
Yeah.
In droves.
People panicked.
Because there was no guidance on the behavior.
Why is it? I think we know that you're supposed to buy low and sell high. Mm-hmm. Or the opposite, I guess. We won't talk about shorting, but you always want your buy to be below your sell. So why is it that so many people
do the opposite?
Do the opposite of that.
It's similar, I think, to weight loss, and I can speak on that because I struggle with that right now. Put on 15 pounds. It's all right.
Full disclosure.
Were you
folks.
waiting for a sympathy clap or something there? I wasn't sure what the pause was.
That's right.
No, you look great, dude.
I got myself. I got myself.
You look amazing. Happy America Day.
Happy America Day.
It is not the 4th of July. This is live on Facebook. This is not a repeat.
Right. I'm just very patriotic all the time. America. No, it goes to, so there's one of the presentations we do, one of the webinars that we teach people on. It's called Mind Over Money. And we have a part in there about the equation to behavior. And it's your cognitive function, your cognitive side of your brain has to be more powerful than your emotions, than your instincts, and your perceptions multiplied by the media. So what you're talking about there, why it's so difficult is the instinctual aspect, which is I see my account, let's use 2008 for example. I see my account go down in stocks 38%. Meanwhile, let's say I had bonds, long-term bonds. Those were up almost 25%. So instinctually, we move away from pain and towards pleasure. So I see something that's up 25% and something that's down 38%. What did the average person do?
Yep.
The average person sold the thing that was painful and moved the money into the thing that felt good. And then you flip it the next year in 2009 in short term or small cap markets, we were up almost 50%, 46%. And bonds were down 15. So if I did that, if I followed my instincts and I sold the thing that was down, I bought the thing that was up, the next year the thing that was up is now down, and I doubled down on my loss. Whereas the opposite of instinct, the cognitive part, understanding the rules of investing, would have stated, okay, this is up, this is down. I sell the thing that's up, at bonds that are 25% positive. I sell that, and I buy the thing that's discounted. Had I done that, the loss I would have sustained in that 2-year period would have been way minimalized by comparison to what most people dealt with. And that's where that cognitive part has to be greater than the instinct. But that is the reason, it's our instincts. Our instincts push us, oh my gosh, like you start thinking about 38% down, what does this mean to my future? What does this mean to my family? What does this mean to my kids? And you let that aspect, coupled with the emotion piece, pull you out of the market.
Because at a certain point, it probably seems like it's just going to never stop.
Bingo.
Like, okay, we're down 30%, we're down 32%, we're down 34%,
Yep.
we're down 36%. It's never going to stop. I have to get out now.
Yeah. And people
Or
are
it's gonna
yelling at
get
you
worse.
on the news to sell now.
Oh yeah, there's this guy named like David Owitz or whatever it was. He was like, it's never coming back. It's never
Really?
getting better. You can't have trillions of dollars out of the capital markets. You can't have housings in crisis, Maria. Like freaking out on national TV.
Oh my gosh.
Like, that was a
That
pretty
was
spot on
the
accident,
best
right?
impression.
Maria Bartiromo?
That was good.
Is that who he was talking to?
Yeah.
That is so funny.
And he said that at the bottom of the market. So, I mean, you're at the bottom of the market and you turn on the news and you got this guy talking about this who supposedly knows what he's talking about. You even had Jim Cramer, and on our videos that we show, we have Jim Cramer and Tony Robbins, both at the bottom of the market talking about getting out. Tony Robbins was like, I'm not a financial advisor, you know, but, you know, I'm going to give you some of my things that I think you should consider. It was basically, he was like, I'm not going to tell you what to do, but I'm going to tell you what to do.
But hold on, let me tell you what to do
Right.
real quick.
Yeah.
It was this beautiful move in language. It was beautiful.
That's exactly what he said.
Yeah, but if you'd listened to them, like you put $100,000 in, right, and you listened to any of them, you would have lost over $200,000 of potential growth just from listening instead of just holding on. That's the kind of decision that destroys people's wealth, and it's the kind of thing that you see all the time. And it's like you were saying, it's before we started the broadcast, like there's fines that go out for companies doing that, and you know they just keep operating because if you can make $1 trillion and lose $10 billion in a fine, net positive.
Great deal.
Like you're
Right.
That's the real investment that's going on. The really big investment that's going on is we'll invest in breaking the rules.
Right.
Because we think we can make more than it's going to cost
And just
us.
straddling that fine line.
Yep.
Yeah.
Yeah.
And that's the problem to a certain degree when you get into like thinking about capitalism and free market spaces and whatnot is you can add more regulation, which hinders the free markets more and may or may not change anything. Or you let the free markets do what the free markets do. Those companies that continually screw people over will evolve out because enough people will stop working with them. But there'll be people that get hurt in the meantime. And I think that's, I mean, again, not in the political side of things, but I think that's a struggle that we see happening now is do we add more regulation to try to stop people from being hurt, which ends up hurting the economy? Or do we allow the market to do what the market's going to do, knowing that there will be some people that do get hurt? Like, you can't save everybody kind of a thing.
Yeah, I don't
Right.
think you can ever save everybody. So I think it's going to have to be that we have to just let it play out. It's a buyer beware situation.
Yeah.
You know, it is your money. You should care about it more than anyone else. That's a really, really important lesson from today. A lot of lessons in there today. You guys are great, as always. Thank you so much for coming on today.
Thanks for having us.
America.
America.